Good afternoon, everybody. This is Angela Raspis, and I'm taking the time to welcome you to the DFK Australia New Zealand webinar today, which is on buying a business, the 6 vital areas to consider before you move forward with a purchase, exploration, and decision. Now, just before we get started into the webinar, I'd like to make sure that you can hear me clearly and that you can see the slides on the screen. So if one of the attendees could take a moment just to type into the chat box, "Yes, we can see, we can hear," then I know that everything is working well before we move forward. Just waiting for a quick response there. Okay.
Anybody?
No one just yet. I'm going to unmute somebody and check. I have a Nathan that's on the call, so I'm just going to unmute you, Nathan, and see if we can hear you okay. Nathan, are you there?
Yeah, I can hear you.
And you can see the slides okay?
Yes, it's great. Thanks, Liz.
Fantastic. Okay, thank you for that, and I'll just click you back on mute again.
Thank you.
Okay, so we're all systems go. We can be seen, we can be heard. Always important to check that with a webinar. So today we want to start this occasion with a quote to keep in mind that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, by Warren Buffett. So that is something to keep in mind as you're taking in all the information and guidance that we'll be sharing with you today. Now, your host today, who will actually be giving you this guidance and these insights, is Melissa Healy from DFK Everalls in Canberra and Gavin Johns from DFK Hernewey in Brisbane. Now, this might be one of your first experiences with DFK Australia and New Zealand. We are actually an association of 15 firms right across the two countries, but we're also part of a larger association of 400 firms in 90 countries right around the world. So the thing we love to emphasize is that when you come and speak with or gain this expertise from the DFK firms, you're really tapping into local knowledge, but we've also got those global connections. So for business owners with big plans, there's all sorts of introductions that we can make for you. But what will we be covering today? Well, in essence, it's our goal really to be educating and empowering you. Today, we want to give you the knowledge of the key areas and issues that you need to look at and consider when you're buying a business. But we'd like to emphasize that you'll walk away with from this webinar with some fantastic resources. There's some handouts and downloads that we're sharing with you, but it's always important to get personalized expert assistance for the actual buying of the business process. So please take that on board when you're thinking of making those purchases. Now, what we're going to be covering today, we'll be sharing between our two presenters, is why do you want to actually buy a business, looking at the different reasons for consideration, and Melissa will be taking us through that. Then we'll move on to what are you actually buying of the business itself, which Gavin will walk you through. Coming back to Melissa for how much are you going to pay for it, looking at the different ways of valuation, and how are you going to pay for it, looking at your different ways of financing your purchase. We'll then be moving on to risk management, and a very comprehensive due diligence checklist is one of the handouts we have for you today. And then very importantly, how to ensure a smooth settlement day, which Gavin will also be taking you through. Now, there will be an opportunity, if you'd like to dive deeper, you can book yourself in for a complimentary 1-hour pre-purchase review with a DFK firm and an advisor that's closer to you. And I'll explain how you can do that towards the end of the webinar. There's also ample time for you to ask questions. You'll see on your control panel that there's a little circle with a question mark in it right beside your name. Now, as we're going through the presentation for flow, we'd like you to type any questions in that you have, and then we'll make sure at the end of the presentation to circle back and answer those for you. So you'll see that little circle with the question mark, which is where you can type in. But we always like to start our webinars with a couple of quick polls so that our presenters can understand where you are, what sort of business you're thinking of buying, what sort of investment you're looking at, so we can tailor this presentation more to the people that we've got on the line. So the polls are very easy to utilize. I will just ask you to click when it pops up on the screen, and then we'll share the results. So there's three polls, will take about a minute each. The first one is, where are you at the moment? Are you looking at buying your first business, going back into business, expanding your current business, or some other reason? So if you could just click there on which one applies to you. And if you have other, it would be wonderful if you could type into the chat box and let us know what that other is, so that again we can make this presentation as specific as possible. So we've got a lot of votes coming through. We've got 60% of people have voted, so we're just going to keep this open for another 20 seconds or so we can get as many of you as possible to give us that feedback. At the moment, we're certainly seeing a big push on the expanding your current business, but I'll share this poll as soon as it's closed. Okay, we're up to 70% votes. Is there anyone else that would like to push our button to push us over closer to that 100% mark? Okay, we're up to 75. Okay, I'll just share those results with you. So we're finding 43% of people on the line are expanding their current business, 21% buying your first business, and 14% going back into business. The other, well, I'll have a look in the chat box later and see if I can give you some more of those details. So thank you for that. Now, the second poll that we have is an understanding of what are you looking at investing, so we can get some feel for where you are in the marketplace. So 3 different options here. If you can just click on the one that's most relevant for you, that will be very helpful for us to tailor the presentation. Okay, we're up to 50%. I'll just keep this open for another 25 seconds or so we can see those come through. We're up to 60% of votes. So click a wee button if there's one there that relates to you. Okay, we'll just let that go for another few seconds. Okay, and I'll share the results. Okay, so we have 56% of our people on the line are looking for spending up to $500,000. Then we've got 22% split between the 500,000 to 2 million and the 2 million plus. So that gives you a great idea of what's happening. Okay, and the last question that we have is an understanding of the industry that you are looking at investing in for your business. So that could be retail, hospitality, professional services, manufacturing, or are you looking at buying a franchise? Now, the software didn't give us the option of putting other here, so if none of those are actually on your list, if there is another area that you're looking at investing in your business or the industry, if you can pop that into the chat box, that would be great. A lot of professional services on the line. Okay, I'm just waiting for the votes to come through. So take a moment to click that button for us. Just let that go for a wee bit longer. We've got 50% of the votes. So if there's anyone else that would like to participate in the next few seconds, and then I'll share this poll as well. Okay, a few more coming through. Okay. So sharing those results, you see professional services, you're in very good company if that's the industry you're looking at investing in. And then a small split across the other options, and I'll check the chat box later as well. So thanks very much for that, guys. It makes it much easier for our presenters to be a little more specific in the presentation. So we're going to move now into the main presentation. I'm going to hand over to Melissa Healy, who'll talk to you about why do you want to buy a business. Thank you, Melissa.
Thanks very much, Angela, and welcome to everyone listening in. Before we dive into how to evaluate a business for potential purchase, including how much you're going to pay for it and how you're going to finance it, I just want to pause for a few minutes to make sure that buying any business is a good idea for you. I'm not trying to scare you out of it, but rather just trying to make sure you know what you're letting yourself in for, and that you therefore have the right skills and experience to take over a business successfully. So the first thing to look at is the personal side of things. Why do you want to run your own business at all? Do you have the technical skills and experience to make it work? Are you going to be able to adapt to technology and industry and economic changes over time? Do you have enough financial skills and experience to be able to juggle your cash flow, price things properly, understand the key profitability drivers of your business and things like that? Do you have enough marketing and customer service skills to look after your clients and produce the goods and services that they want at a price they're actually willing to pay? Do you have enough HR skills to recruit, retrain and reward your team members? As Richard Branson says, your team are your first priority, because without a happy team, you won't have happy customers. And last of all, do you have the skills to be able to create and document clear systems and processes to make sure that your team knows what to do, how to do it, and why to actually do it that way, so that your customers get a consistent experience each time they deal with you? The second thing I want us to think about is, why not set up the business from scratch? I mean, would it be cheaper to set it up yourself rather than paying somebody for their business? After all, you're usually paying a premium for someone else's business, but you can never be 100% sure that things will work out the way you expect. The other advantage of starting from scratch would be that you get to set it up the way you want from day one, rather than having to retrain employees and clients to, this is the way we're doing it from now on. If you're buying an existing business, and that's the right way to go, then we still want to pause and look at what our goals are and how this purchase fits into our strategy for achieving these goals. So, for example, are we buying a business to gain market share? For example, by buying a geographical territory, or by getting rid of a competitor? Or are we buying a niche that is, a capability to provide a complementary product or service to what we already do? And lastly, I just want to look at, why this particular business? Are there other similar businesses available for sale, or even ones that you could make an offer to, that would perhaps be better value? For example, they've got better revenue potential, better equipment, a better team, or better systems and processes, even if this means that you have to pay a bit more for it. Because as we quoted earlier, it's much better to buy a great company at a fair price than a fair company at a great price. So have a think, and on that note, I'll hand over to Gavin to talk to you about exactly what you're buying. Over to you, Gavin.
Thanks, Melissa, and can I also give everybody on the line a warm welcome to this DFK webinar. So after you've been through all of the considerations that Melissa has mentioned there about why you want to buy someone else's business, and you've reached the conclusion that you do, it's really then time to think about, well, what is it that we're actually going to buy? So in practice, we generally see two scenarios with what it is that you're going to buy. We see either A, you'll buy the business assets, or secondly, you might be buying the shares in the existing company. Now that's not to say that they're the only two scenarios that we see in practice, but they're probably the two most common. So when I talk about buying the business assets, I'm talking about you set up your own structure, you come along and you buy the key things that you need from the vendor to operate the business going forward. And that's generally the goodwill, the stock and the equipment that's required to run this business on an ongoing basis. If you're looking at buying the shares in an existing company, that's a little bit different again. That's where you come along and you literally, the transaction is on the shares themselves. You take over the shares, the vendor steps out, you step in, and the business rolls on in its existing structure, and you're basically going forward with all of the assets and all of the liabilities that were in the existing vendor structure, and you continue to run the business that way. So what I'm going to do now is just for the next few minutes, I'm just going to delve a little bit deeper into those two options, and we're just going to look at some of the pros and cons of each. So firstly, when we think about buying the business assets, and as I said earlier, that generally refers to stock, goodwill and plant and equipment, the bits and pieces that you need to run this business on an ongoing basis. Now, there are some advantages of that structure. When you do just buy the business assets, you're basically a clean start. You've got the option to purchase exactly, or set up rather, exactly the structure that you need. So whether that be a company, trust, partnership, sole trader, combination of the above. As I said, it's a clean start. There's no hidden liabilities. You get the structure that suits you. You get the assets that you need to operate the business, and you set off and you're the owner of that business, and off you go. All of the other assets and liabilities that are within the vendor structure remain with the vendor. So we don't worry about things like collecting his debtors or paying his or her tax liabilities or things like that. You just get what you need to move forward. Now, of course, there are disadvantages with that option as well. The disadvantages are that there's a hassle factor. You need a new business bank account. You have to set up a new ABN. You need a new tax file number, new GST registrations. There's new letterheads and invoices. There's potentially new contracts with customers, suppliers, employees, your landlord, things like that. Now, the other scenario that I mentioned is where you buy the shares in an existing company. Now, if you're looking at that as an option, as I said, that's where you buy the shares, the vendor steps out, you step in, and you operate the business from that point onwards. There's certainly an advantage in that option because there's less administration on the change. You don't need a new ABN, a new bank account, or contracts or things like that. For all intents and purposes, the business simply rolls on. There's no sort of discernible change, I guess, from a customer or supplier's point of view. They're dealing with the same entity. So there's certainly less administration on change. There can also be potential stamp duty savings, and I know from where I'm based here in Queensland, you don't pay stamp duty on the transfer of shares. So I mean that could be a consideration for you as well. Of course, there are disadvantages when you buy the shares in an existing company, or potential disadvantages. What skeletons are in the closet? And I always like to use that term because what could be in there that you don't know about? Now, we are going to talk about due diligence a little bit later on, and hopefully any skeletons in the closet you find, but are there any potential hidden liabilities within the existing structure? Are there any potential HR issues or customer or supply disputes that are going to pop their head up in the future? If you do go down the path of buying shares in an existing business, the due diligence is probably a little bit more important. So yeah, that's something to consider, which we will talk about a little bit later on in the session. So keep those thoughts in mind. I'm now going to hand back to Melissa, and she's going to step you through how much you're going to pay for the business and how you might be able to finance it. Melissa.
Thanks very much, Gavin. So, yeah, my job is to talk to you about the difference between price and value, because they aren't the same thing. The price is what a willing seller is willing to sell the business to a willing buyer for. The value is always going to be different. So the value to the existing owner is going to be quite different to the value that you see in the business, and therefore it's going to be a process of negotiation. So no absolute certainty is provided by any valuation methodology, but it does provide at least a reasonably arguable position in any negotiation. So either way, you need to have a really good understanding of the industry that you're getting into, the market potential, and any risks involved. So let's have a look at how you actually value a business. It's basically determined by looking at three main areas. We look at the earnings, so how much gross income, gross revenue that the business makes, what its maintainable profits are, EBIT and EBITDA are variations on that, and its free cash flows. We also have to look at the risk involved in this particular business and industry, so how stable have the earnings been in the past and going into the future? Does this particular business or industry have a competitive advantage? What are the investor perceptions? So, are people concerned about this particular industry? And we also need to look at the position in the industry life cycle. So, for example, I hope we don't have too many people interested in buying video stores. We also have to look at the political and economic instability that can be around. It's amazing how the business life, everything does go on despite the political shenanigans that we have to put up with from time to time, but it is definitely something that has an impact on business and markets in general, so need to bear that in mind. The third area that we need to look at is the potential, and this is the fun area, because this is where you're buying a business because you think you can run it better than the current owner, or there's economies of scale that you can get out of this business by incorporating it into your existing one. So as we talked before about, expanding your market share. So this is where we're looking at being able to enter an untapped market, get those economies of scale or synergies from running the two businesses together. Is it of strategic importance? This is where we talk about vertical integration and horizontal integration, things like that. But having related businesses that support each other. Looking at the IP and what you can use out of that, and also management experience and expertise. So let's have a look at the actual methods. There are 5 main ways of valuing a business. The first one is the most common method. This is called capitalization of FME, being future maintainable earnings. The types of business that this kind of method should be used for are mature businesses, those that have a stable revenue stream, a good history, and based on that have reasonable certainty of their future earnings. The strengths of this kind of method is that it's widely used and accepted. It does rely on the past as a basis for the future, so at least you've got something to base it on, and it's useful from a comparison point of view because it is so widely used. But we have to look at the weaknesses, and that's where we have a problem that we're we're assuming that the future will also continue the same as the past, and as we know from technology changes and things like that, that's not always the case. It's also an unreliable or perhaps an unfair method of valuing a business where there is significant volatility in its earnings, because we're using historical earnings to kind of predict what the future earnings are going to be. If those historical or even future earnings are likely to be volatile, you're not necessarily likely to get a true value this way. And for those same reasons, it's less reliable, therefore, for immature businesses, simply because they don't have that track record. Looking at this particular method in a little bit more detail, the way you actually calculate the value of the business is to work out those future maintainable earnings. So, for example, that might be some sort of weighted average of the last 3 years net profit, and then we simply times that by a capitalisation rate. The things that affect that capitalisation rate include, well, I've got X amount of dollars to invest. If I put it in the bank on term deposit or something, how much money, how much interest could I earn from that, compared to, am I willing to put it into this business? How much rate of return am I going to need to make up for the level of risk involved in running a small business versus a term deposit in a bank? We also look at the amount of forward contracts in place and annuity income. So in other words, the more certain the future income is going to be because we've got those contracts in place, then the more valuable the business is, because the more guaranteed you are of definitely getting that income stream that you're paying for. We also look at the capital investment required to maintain those income levels. So for example, if you're buying a business that's heavily reliant on either a piece of machinery or a whole stack of equipment, well, how often do you have to replace that equipment to continue your income stream? So the more often you have to replace your equipment, the less you're willing to pay for the company, because in a few years you're going to have to pay a bit more. The walk-in, walk-out level is also really important in this area. So what we're looking for here is the systems and procedures in the business. Have they gone to the trouble to document how they do their business, so that you can walk in, they can walk out, and the business will continue with those same, the customers will be happy to transition, things like that. So where a business is heavily reliant on the owner, for example, it's a one-man band, the capitalisation rate is actually quite low, whereas if it's a much more organised business where the owner can come and go and doesn't make a big difference to the ongoing running of the business, well, then it's worth a lot more, because you stand a better chance of being able to take it over. And of course, we also take into account the financial market conditions and current technology. So the most common multiples for small medium enterprises are in the range of 0 to 5. So, as we said before, a business, a one-man band that's completely reliant on what's in his head to make everything happen, well, that might be a 0.5 or a 1, whereas a well-structured business that's independent of the owner and will be easy to take over, well, that might be worth 4 or 5 times their future maintainable earnings. what we tend to see is that the most common multiples used for SMEs are between the 2 and 4 range, but as I said, it does depend on all of those factors, so you need some expert assistance to work out what it's actually going to be worth to you to take over. The second method that I'd like to look at is the discounted future cash flows. So the previous method was more about businesses that had that history, and we were forecasting that history to keep going with the same revenue levels. This method is much more for businesses that are growing businesses that do have locked in forward revenue streams that perhaps they didn't have before. So the history is more irrelevant and what's going to happen in the future is relevant. So we simply look at what those future cash flows are worth to the business and then discount those back to a present day value. Very straightforward. The strengths of this kind of method is that it does have a very strong technical background because you do have, forward contracts and numbers that you can crunch. And it does focus on that future cash flow stream, which in the end, what the previous owners did is kind of irrelevant to you once you're running it. What you're really interested in is this future cash flow stream that's being purchased. The weaknesses of this method are that it requires both reliable historic and future cash flow forecasts, and it does require an assessment of a wide range of industry and finance factors to actually determine how much you're going to discount those to the current values. But otherwise, it's a good method. The next method I'd like to look at is the net asset backing. So this method is more commonly used for businesses that are dominated by their tangible assets. So these are those businesses with lots of equipment, for example, that's required to operate the actual business. So they're the ones where there's limited or no goodwill, and it's all based on those equipment. The advantages or strengths, shall we say, of this method is that it is inherently conservative. It's much easier to value, identify and value tangible assets, so you know what you're paying for. So it is a typically low risk assessment, and it's a really good secondary method for double checking the valuation that you came up with using one of the other methods, for example. In terms of weaknesses of this method, the other side of the argument is that it is inherently conservative. We're not allowing much in the, for the intangible assets of the business, such as their goodwill and client base. So just have to bear that in mind. Now, the next method is not so commonly used anymore. It's more, it's the rule of thumb kind of method, where we value a business according to some sort of rule of thumb or industry norm. So in the previous methods, we've been talking about valuing a business, for example, based on a multiple of its profit or based on what assets it's got. This is a kind of method where we look simply at a percentage of turnover. So it's really handy for businesses where there are lots of those kinds of business in the industry and everybody knows how they work and operate. So chemists, for example, have specific rules about what they do and how they do it. Same for newsagents. Financial planners are a classic example of percentage of turnover. But even those kinds of industries, all of those are now starting to move much more towards a profit multiplier kind of method rather than these ones. So this is an old way of valuing things, and usually for much smaller businesses, definitely not used for bigger businesses where there are assets and team members to take into account. The last method that I'd like to talk to you about is the cost to create model. So this one is where we're looking at simply how much it would cost us to create the business from scratch rather than paying someone else to do it. Now, this is just, we do want to buy the business that's already established. So what we're doing is looking at businesses that have limited intangible, that do have limited intangible value and limited tangible assets. So it's more relevant for the small startup businesses and loss-making businesses where we don't have that profit to be able to multiply by something. So all we're doing is looking at, it's a reasonably easy way to calculate, it's quite conservative, and it does incorporate the barriers to entry risks. So the idea here is this is where you're willing to pay somebody for the business that they've established because they've obviously done all the hard work, but they've, for example, they've bought the franchise, so they have the franchise rights, or they've got the territory rights to a business. So it's not a business that you can set up because somebody else actually has the rights to it in a particular area. The weakness of this particular method is simply that it does only allow a limited value for the goodwill or intangibles, and of course there are some subjective judgments required in the calculations. So there you go, 5 different ways that you can value a business. Always good to maybe use 1 or 2 to double check that you are coming up with the right figures. But at the end of the day, you have to remember that what the business is worth to you, because you can see the potential in it, or you're not very good at setting them up from scratch, whatever the case may be, it's going to have a value to you, but the owner is going to have their own interpretation of what the business is worth to them. So then it comes down to negotiating between the two of you to come up with a price that you guys are actually happy to sign the deal with. So assuming that you do manage to agree on the price for the business and agree to the sale, what I want to run you through now is the different ways you can actually finance the purchase. So let's have a look at how we can finance it. There are different components of the purchase price. So as we've mentioned before, if you just buy the assets out of somebody else's company, there's going to be plant and equipment, there's going to be goodwill, various bits, there'll be stock, all that kind of stuff. If you're buying the whole company, well, you're going to get bank accounts, you're going to get debtors, you're going to get work in progress. Of course, you get all the liabilities as well. So let's have a look at how we can finance those different components in different ways to help you come up with the money, basically. And the big thing too is that we don't want to forget that we're going to have ongoing working capital requirements. So for example, you're going to need a little bit of extra cash to keep you going for the first 3 months until things settle down and the checks start coming into your bank account. So looking at this in a little bit more detail, different types of finance can be used for different components. If you've got all the cash up front, brilliant, go for it. But if you don't, let's have a look at different ways you can finance it. So for example, if there's a goodwill component, banks will sometimes give you a bank loan. So there's obviously different types of loans, whether it's a redraw on your house or things like that. But usually a 5 to 10 year business loan can be obtained from the bank, but they're obviously going to need good figures, cash flow forecast, etc., from your business. And what they're also probably going to need is security. And the bank's favourite security is spare equity in your own home. So making sure that you do have some way of securing a bank loan to keep the bank happy is a good idea before you get too far down the track. One of the other components we talked about was the plant and equipment. There's a variety of ways of financing plant and equipment. So for example, you can lease it. Similarly, there's hire purchase contracts and chattel mortgages. They all have different tax kind of issues to them, but the basic drift is that when you get a loan for something, you have to pay back 100% of the value of the loan by the end of the loan. And that makes your monthly repayments a certain amount. If you get to lease equipment or HP chattel mortgage, the advantage there is that you have a residual payment at the end. So for example, you only have to pay back, say, 80% of the borrowings over the term of the loan, and then you sell that plant and equipment, trade it in on the next replacement piece. The trade-in value of that plant and equipment is what you then use to pay out the old lease, and then you get to start all over again with a new lease. But because you're only paying back 80% over the term of the loan, the monthly repayments are lower, and that can be of great assistance to starting businesses' cash flow. Don't forget to talk to your suppliers about opening up accounts with them. So, the most common one is 30 days after the end of the month, you've got to pay your bills. The advantage there is you get to buy all the stock and bits and pieces that you need, but you don't actually have to pay for it for another 30 plus days, and that's interest free, so that's a bargain. The other thing that you can do is talk to those suppliers and sort of say, look, I'm new, I'm taking over, don't have a lot of cash flow yet, but it is definitely coming because I've got a brilliant business plan. Is there a way we can do a deal where, for example, for the first 3 months or 6 months, I get 60-day terms or 90-day terms or something, just to help you out and get you up and running properly. So never underestimate the advantage of that kind of interest-free money. And if nothing else, you can only ask, so let's go for it there. Looking at working capital and your ongoing expenses, try an overdraft or a credit card. Obviously, there's a lot of stories about people setting up their businesses on a credit card. Just be really careful. The interest rates are very expensive, the most expensive of any type of finance. So if you are desperate enough to use a credit card, please make sure that you do pay it off at the end of every month. An overdraft is probably a safer bet and a bit more flexible. The thing to watch out for with overdrafts, though, is that the idea of an overdraft is that the balance goes down for example, at the beginning of the month as you buy stock and pay bills, but then as your customers, you sell things and your customers eventually pay you during the month, the balance comes back up, and it needs to come back up such that you're in positive territory again. There's actually money in the bank account, and then next month it can cycle again. So an overdraft should only be used where you do cycle between being an overdraft back to having money in the bank. If you've got core debt, in other words, your overdraft never gets, shall we say, back above a particular level, if it's always overdrawn by a certain amount, it's really a waste of money, so to speak, in terms of overdrafts are usually given at a higher interest rate than bank loans. So if you've got that core debt that you're never paying off month to month, then you're actually better off refinancing that as a bank loan, paying a lower interest rate on it, and making it such that your overdraft does go back into positive territory each month. And last but not least, if you have to get business premises, most of the time, if not all the time, the landlord's going to require a bond of some description. Now, this might be 3 months' rent, for example, to be put on term deposit, or in a solicitor's trust account or something, to make sure that you do pay your rent all the time. If you don't have that kind of money lying around that you can leave locked up, in this term deposit or something, then you can actually pay a fee to the bank for them to guarantee a bond for you, so that you don't actually have to cough up the whole lot. The advantage of doing that is that you obviously don't have to come up with the cash, and it's just the fee. But the thing to watch out for is obviously the fee, but it's also that the bank will probably require some sort of security one way or another. So again, that might be security over your own home. So make sure you do your homework up front, have a good talk to your bank manager to make sure that you've got a very clear understanding of what components they're willing to finance and how, and what security they're going to need to go forward. So now that we've established how much you're going to pay and how you're going to finance it, I'm going to hand you over to Gavin for the nitty-gritty detail of making sure that you are actually going to get what you pay for. Go for it, Gavin.
Thank you, Melissa, and yeah, all very good tips there as you make that all-important decision on what business you're looking at buying. Now, I'm actually going to jump into the risk management discussion and particularly talk about risk management and due diligence. Due diligence, and for the 56% of you, or the 43% rather, that are looking at expanding your current businesses, you may have actually had some experience with the due diligence process if you bought your original business. Others may not have. So what is due diligence? I think that's probably important to look at straight up. Due diligence is really your opportunity to dig a little bit deeper, identify the risk areas, and remember, it's not just about the numbers. There is a common perception out there that due diligence is all about the financial statements and all about the numbers, and we dig deep into that, and that answers all of the questions. It's not just about the numbers. And remember also, it is time critical. Once you've signed that contract, your contract will have a specific due diligence period in it. So everybody needs to get moving and get on with it, because that is, as I said, very time critical, meeting that due diligence period within the contract. So, as I said, the objective of the due diligence is to identify the risk areas, and you're going to need to develop a work program or a checklist to work out where you're going to focus your time and energy. Now, for the 56% of you that are looking at spending, no more than $500,000 on a business purchase, your due diligence checklist is probably going to look a little bit different to the 22% of you who are looking at spending more than $2 million. So you do need to tailor your due diligence reviews a little bit to A, how much you're wanting to spend, what your budget is, and also the type of business that you're looking at buying. Now, again, I saw at the beginning of the webinar that 85% said that they're interested in buying a business in the professional services area. So based on that, you probably wouldn't need to spend a lot of time delving into things like plant and equipment or stock, because that's obviously not going to be a large component of those types of businesses. Now, with your due diligence, your advisor is the best placed person to assist you with your due diligence. So you'll be wanting to make sure that your accountant has got a heads up. Presumably, you've been talking to him or her during the business purchase process anyway, during the evaluation process and the contract negotiations. So I'm sure that they'll be sitting there ready to go when the due diligence period starts. They're the best person, the best placed advisor to help you and step you through the due diligence process. However, you can't leave it all up to them. As a business purchaser, you also need to do some of the legwork and work hand in hand with your advisor to make sure that you are actually covering off on the sorts of things that you need to be looking at. Now, one of the handouts that is made available to you today as an attendee of this webinar is a due diligence checklist. So I would encourage you all to take the time to download that. Now, it is by no means an exhaustive checklist, but it's something to over 3 or 4 pages, which will hopefully point you in the right direction and give you some ideas and some thoughts as to, and so when you start to develop your action plan and your checklist, you're aware of some of the things that you need to be looking at. So what I'm going to do for the next 5 minutes or so is I'm going to look through some of the more common areas that come up and need reviewing in detail in a due diligence review. So on the list there you can see half a dozen items. For example, now the first one is revenue, and we all look at the financial statements and the revenue's right there in black and white on the top line, but what are some of the trends around that revenue? Has it been increasing over time? Has it been decreasing over time? And if so, why? What has led to that? I would also recommend that as part of your due diligence around revenue, you don't just stop at the financial statements, but you obviously look at the business activity statements for the business, or in a retail business, you go right back to the point of sale reports. Now, are all of those reports and items that are available to you consistent? Are they all telling the same story? Is the revenue consistent with what the industry is doing for a business of a similar size, for example, in a similar industry? They're all the sorts of things that you need to consider around revenue. Now, with respect to your customers, you need to delve a little bit into the customer or client list. How many of the customers on the list are active currently, and how many are no longer active? And if they're no longer active, why are they no longer active? Are all of those customers going to transfer their business over to you with no questions asked? Or is there something about you and the way you plan to operate the business that might impact on some customers' decisions to do business with you in the future? Likewise, with the suppliers, get a list of suppliers. Are there contracts in place? Are they transferable? Will you be able to secure the same terms and payment terms, price discounts, volume discounts, all those sorts of things that the vendor currently has? Are they going to be available to you? And when you're looking at customers and suppliers, you're also delving into the receivables and the payables, or the debtors and the creditors. If you are buying the shares in a company and you're therefore taking on the debtors, you want to be having a really close look at the debtors in that debtors list. Are they all recoverable? Is there any bad or doubtful debts that might be buried in there that need to be addressed before we sort of go too much further? And likewise with the creditors, are all the creditors disclosed in the payables list? Are there any that might be missing that you know might be going to get a big invoice in a month or 2 months' time after settlement that you weren't expecting? Employees is a very important one, and it's something where you really do need to spend quite a bit of time. There's often lots of differences of opinion around what the true cost of wages is when you're doing a due diligence review. So you really need to understand the staffing structure of the business you're buying, understand the work patterns and the work arrangements of all of the employees. You know, you need to get all the details of all of the employees, names, addresses, tax file numbers, all of those sorts of things. But you need to understand who's permanent, who's part-time, and who's casual. What are the awards and workplace agreements that they currently work under? Who are the critical staff for the ongoing success of the business? Are any of the staff privy to trade secrets that the business might have, or any intellectual property that the business might have, that those people are particularly critical to the ongoing success of the business? What's the staff turnover been like for the last 3 or 4 years? And if it's been high, is there something that has caused that you might need to dig a little bit deeper into? One very important one is, are there any staff that are related to the seller of the business? And if so, are those wages actually in the financial statements at the market value for the work that person does? Or if not, has the purchase price been adjusted for that? And I only had a due diligence example within the last few weeks that I was working on for a client where the vendor had one of their children worked in the business on a fairly regular basis, but was adamant that the work that person did had little or no value. And then when we were doing our due diligence review and asked for all of the various employees and job descriptions, we got a 3-page job description for that person that supposedly had no market value to the nature of the business. So they're the sorts of things you need to be looking out for. And just while we're talking about related parties, you also need to have that same consideration when you're looking at customers and suppliers. Are any of the customers or suppliers related to the vendor? So they might be quite happy to do business with the person that's selling the business, but not so happy to do business with you. Or if they were dealing with the vendor of the business and they are related, were all of the transactions at market value? Moving on to equipment, and as I said, it may not affect you so much if you're looking at a professional services type business, but some businesses do rely very heavily on the equipment they're purchasing. So you really need to inspect and cite the equipment. Make sure that the items that are listed in the contract are the items that you're actually going to get. Get a list of makes, models, serial numbers, things like that, and ask for the service and maintenance history of those key items so that you could be very comfortable that they've all been maintained in good working order. The next item on the list there is the intangible assets. So does the business rely on things like patents or trademarks? Are those patents or trademarks registered? Are they protected? Are those registrations current? Are they transferable? All of those sorts of things, because all very critical to the ongoing operations of the business. And the other item in that list is the property and the leases. Is the lease transferable? What does the current lease say? Is the lease going to be assigned over to you with the same terms and those sorts of things? The other things that you do want to be looking at is other things around this. What are the strategies that the business implements? What are the internal controls and systems? And how comfortable are you that you can adapt those to your running of this business in the future? What's the corporate governance and the statutory compliance like with this business? Are all the filings up to date? Does it have if you're buying the company, does it have a good lodgement history? Is everything up to date with ASIC, for example? Does it lodge its payroll tax returns on time? Does it lodge its BASs on time? Are there any other financial issues that you need to be aware of? And also, what about any legal type issues? Are there any pending claims or any warranty issues for products that you maybe manufacture that you need to be providing a warranty for the next 5 or 10 years that you really need to be factoring into your thought process as you acquire this business, because these things you will be responsible for well into the future. And then moving on from that, as I said earlier, related party transactions, very important, and very important to understand that everything is disclosed at market value. So they're just some of the items that I wanted to touch on today when we're talking about risk management and due diligence. As I said, it is very important. It is time critical. Take the time to download the checklist that we've provided there today. And in that checklist, you'll see a number of those items that I've just touched on today. But you also will see some other general considerations that you need to think about as well. For example, what economic or industry factors will influence your business over the next 10 years? Is government regulation likely to have an impact on things? Who are your competitors and what's their proximity to the business? So, for example, if you were buying, say, a pharmacy, and I've done due diligence on a number of pharmacies over the years, what's the proximity to the nearest doctors that pharmacy might rely very heavily on? How long are they intending to be in the area next door in business? All those sorts of things. So as you can see, it's not just about the numbers. There are a number of factors that you really do need to consider, and you need to be quite comprehensive, because this is your opportunity to get it right before that contract goes unconditional and you're handing over your hard-earned money. So what I'm going to do now is I'm just going to move forward to the final stage of buying the business, and that's basically settlement day. So we've done everything right, we've found the perfect business for us, we've valued it correctly, we've got the bank on board to finance it, we've done a great due diligence, and we've gone unconditional, and now it's settlement day. So what do you need to do to make all of that go smoothly? And guaranteed, no matter how many things you think of, there'll always be one or two that you don't. But hopefully today you'll get to know some of them that you don't overlook. But you're going to be busy on settlement day, and you're going to be very excited because it's time to get on and run your business. But what you need to do is, most importantly, make sure you have the money ready to pay. There's only one thing that the vendor's probably going to be too interested in on settlement day, and that's getting paid. So that's probably top of your list. But what other things do you need to be thinking about? You need to be, is there a stock take required? Do you need to get your team in there on settlement day and perform that stock take? As I said earlier, taking possession of the plant and equipment, making sure that the assets you're acquiring on settlement day are the assets that you signed up for in the contract to buy. Making sure that they're unencumbered, and you search the securities register and make sure that all of any leases or chattel mortgage or things like that have been paid out or cleared. If you're acquiring work in progress or ongoing jobs that need to be completed, do you have everything you need to complete those jobs? Do you know where all of those jobs are at? Do you have everything you need to keep going forward? If you're setting up with your own new company or new trust or new entity, you'll want to be signing up your employees and customers and suppliers to new contracts and new tax file number declaration forms and so forth. All of those little things that just need to be done. Have you got all the necessary licenses, registrations transferred over to you or your entity? Have you got the insurance in place so that your assets are insured from the day that you take over? If you're buying the shares in the company and you're taking over the bank account, have you changed the signatories on the bank account so that you can operate from day one and you don't turn up to the bank and they don't know who you are? And one that I've seen, the very bottom one, I've seen a number of times, is have you actually got access to the bookkeeping data file? And I've seen this a number of times where everybody gets so swept up on settlement day and doing everything that they need to do, the very first time they go to log into the MYOB file to start raising some invoices, nobody knows the password. And of course, then there's multiple frantic phone calls being made to sort that out as well. So there are some of the items that you need to consider as you get down to settlement day. And I know this webinar is about buying a business, but what to do next is important as well. It doesn't all just stop on settlement day. So I just thought I'd spend just a couple of minutes looking at what you need to do beyond settlement. And these are really important things to do. So you need to review your goals. You would have had a goal when you looked at acquiring a business. Where do you want to be in 5 years' time? And what do you want your business to look like in 5 years' time? And you'll see there we've put start with the end in mind. Often when people are buying a business, they're buying it with an exit strategy or a succession strategy already in mind, and that is sometimes can be a good thing. What's your strategy or action plan to get there? And who's going to help you get there? And when do you want to be there by? And as I said, if it's a 5 or 10 year prospect, then that's what you need to consider. You need to keep it simple. Focus on your goals and focus on the business plan that you would have set, the SWOT analysis that you would have done when you first acquired the business. I often refer to the business plan as a living document. It's something that you need to be constantly referring to, constantly updating. Once you've bought the business, don't just put it in the bottom drawer and forget about it. It is something you need to be reviewing on a regular basis. And make sure that you set aside the time to work on your business, not just in it. Very important. I know it can be very exciting that you're now a business owner and you've got a lot of things to do and you want to get in and do it, but I recommend that you do set the time, whether it be 1 hour a week, 1 day a week, or half a day a week, but just make sure that you devote some time to working on the business and not in the business, because being a business owner, it is very important. And go for it. As I said before, congratulations, you're a business owner. Enjoy the experience and don't be afraid to ask for help. Engage your advisors around you. Engage your accountant. Where necessary, your solicitor and your banker. I often say that those three are the most important people in your management team, your accountant, lawyer and banker. So don't be afraid to ask for help from those people. They're the ones who are generally best placed to assist you, and often can be quite useful because looking at it from an outsider's perspective as well, someone who's not so close to it, they're not seeing obvious things. So what I'm going to do now is I'm going to hand back to Angela, who's going to step you through some of the ways that DFK can help you and some of the offerings that we're making to you as part of this webinar. Over to you, Angela.
Hey, thanks, Gavin. Okay, everybody, there was a lot of information that you've taken in over this presentation. You can see that there's lots and lots of different aspects you need to take into account when you're making such an important decision. Now, I've had a lot of questions coming through the panel, and yes, there is a recording of the presentation which will come out to you in the next 24 hours, so you can go back and pause and take notes and get that guidance that you really need. But I do want to point out, as has just been highlighted, is that we're wanting to help you succeed in this purchase. So we're offering a complimentary 1 hour pre-purchase review, and we'll match you up with a DFK advisor in the firm that's closest to where you are. So the link, or rather the address, because you can't click on it here, that you can go to book that, or to put the application in, so that we'll then be in touch and find a time that suits you. If you go to the bit.ly/biz purchase, and then we'll take some contact details so that we can get in touch with you. I've just seen coming up from a fellow by the name of Kevin who said he has to run, but he'll be in touch for the checklist and the review. No problems at all. We'll look forward to hearing from you. And yes, Gavin and Melissa have referred to the handouts that are in the control panel for you. They'll also come out in the email, but one of them is an infographic that takes you through the flow of this business purchase decision. There's also the infographic on the valuation methods that Melissa went into in great detail. And of course, there is the due diligence checklist, which is also very, very important for you to go through. So make sure you grab those and and download those and make the most of them. So I've got 3 questions that have been sent through, which we'll come to in a sec. I just want to also point out that in addition to the particular review that you can book with our compliments, DFK ANZ actually does cover, as you would imagine, many other areas to assist business owners and entrepreneurs, from strategic planning workshops right through to coaching, due diligence, business valuations, of course, and guess what? We do accounting and tax as well. So there's many, many services that we can help you with, and we'd love to have a conversation to see if there is ways in which we can be of service. So please keep that in mind when you're booking in those meetings, because there's many ways that we can help. So look, thank you so much for the time that you've put in so far on this webinar, but we're just going to extend that slightly to answer these questions that have come up. So I've got 3 to start with, but if you do have one, please also type it into the chat box and we'll make sure that gets answered. But the first one is from Kent. We'd like to know, this is to either of you, Gavin or Melissa, so I'll leave it up to you to decide. But what is your view on add backs on EBITDA, and particularly in respect to vendors seeking depreciation on stock to be an add back?
I think that one there. Sorry, Melissa, go.
No, that's fine. You can handle it.
I was going to say that's probably one that's fairly topical, and I don't know that there's an exact answer to that one. Depreciation is one that we find, well, I find certainly in practice, that often causes lots of not say disputes, but lots of sticking points and lots of discussions around whether it should or shouldn't be added back, where it should or shouldn't be added back, and how you deal with it. And then, unfortunately, it's not an exact science, and there are a number of schools of thought about it. But I think really, if there is some depreciation in the value, then that is marking that value down, then it probably really should be adjusted for. Melissa, did you have any thoughts?
Yeah, I was going to say, yeah, we get asked this one quite regularly as well. We tend to say no, it shouldn't be added back on the basis that having that plant and equipment is usually a critical component of the business. That equipment does wear down over time, and therefore the depreciation charges, assuming that they are proper accounting, like based on effective life kind of depreciation, does represent the natural decrease in value of that stuff, and therefore it should be counted as a normal business expense. When you have small businesses that, for example, like at the moment, anything less than $20,000 can be 100% appreciated. Well, it's obviously not fair to write off 100%, to not add back anything in that regard. You want to swap that 100% for, say, a 20% depreciation charge, assuming that the gear's going to last 5 years. But so putting aside the tax depreciation figures that a lot of small businesses just use as their accounting depreciation figures, it's a normal cost of running a business, having that equipment and having the natural wear and tear on it. So leave the depreciation in and don't add it back.
One thing I have seen too in practice, which is starting to happen more recently, is no add back for the depreciation, but then an adjustment at the end of the final price arrived at for an allowance for future expenditure on capital assets. So you sort of get it that way. Yeah. So I've seen that starting to happen a little bit more in practice in the last probably 2 or 3 years as well.
Yeah, I guess what potential owners need to bear in mind is the age of the equipment that they're buying too. So if the equipment's already old, the depreciation figure in the accounts at the moment won't be terribly much, like there won't be much left. Whereas if this person buys the business and then, with the understanding that in a year or two they're going to have to buy new equipment, well, that's obviously going to be a significant expense, and it needs to be allowed for in the purchase price. Hopefully that answers that question. Another one, Angela?
Sorry, I'd muted myself. Thank you for that. Hopefully that was helpful, Kent. The next question is from Brian, and he asks, if I buy a business with a partner, how should I insure them so I retain the equity if they die?
That's an excellent question. And sorry, Melissa, I was going to say we generally structure those with what's called like a buy-sell agreement, or you often hear them referred to as well as a business will. They're a legal document, and basically it sets out exactly what happens in the event that one of the usually arm's length partners is either dies or permanently disabled and needs to exit the business. And the business will, or the buy-sell agreement, sets out some terms. Usually there's some insurance held as part of that agreement that facilitates the transfer of the outgoing partner's equity, so that the surviving or the continuing partner can continue on with the business. So yeah, a buy-sell agreement, or as I said, often referred to as a business will.
Yeah, exactly. That's what we do as well. So set up a buy-sell agreement, set up an insurance policy over each person. There's a couple of different ways of doing it in terms of you can have you can insure your partner so that if something happens to them, you get the insurance payout, and then you use that insurance payout to pay out their estate for the value of their half of the business. So you've got no cash left over, but at least you've got all of the shares, for example, in the company. The other way of doing it is you all self-insure, but then you have the buy-sell agreement that says if you get proceeds from the insurance policy, your estate then has to sell the shares back to the surviving party for $1. So either way, you don't have the cash, but at least you got the shares.
Okay, great. Well, hopefully that was helpful, Brian. The next question is from Alan. He asks, how much cash should be left in the business as working capital, and is the sorry, I can't read my own writing, as an individual as an addition to the purchase price? So how much cash should be left in a business as working capital in addition to the purchase price?
I've got some clients who like using, they're very conservative, and it's a services-based kind of industry. They like having 3 months' worth of overheads in the bank. So you look at your profit and loss statement, whatever your overheads are, 3 times that sits in the bank account for emergency purposes. So if anything happens, you've got enough money to cover the bills for a while. That is in a perfect world scenario. I don't think the vast majority of businesses have that much cash lying around, so to speak. But it's a matter of looking at your particular business and look at the things that could go wrong and how much money would you need to be able to survive that. So if the place burns down, obviously that's a bit different to other dramas where you get sick or something like that. But trying to work out, what do it as a proportion of your overheads. Look at your expenses. Which ones would you be able to stop pretty quickly? Which ones are you committed to? For example, your landlord lease and things like that. So, and then just work out what time period you're comfortable with.
Yeah, completely agree. 3 months of operating expenses is a good rule of thumb and a good place to start. And as part of your due diligence process as well, you'll be seeing financial statements for the business for prior years. So often you can get a feel from that as to the cash requirements of the business. There may be something unique about the type of business that you're buying that means it requires a higher or lower level of cash. So you need to actually look back a little bit and just see what the normal operations of the business, and not for the period just prior to you acquiring it, but going back just a little bit further as well to see if you can assess what the ongoing cash requirements are. But yeah, certainly 3 months operations is a good start.
Okay, brilliant.
I suppose it also depends.
Sorry.
Sorry, I was just going to say it also depends on how much money you've got outside. So, an established business, if the owner has money tucked away that they could, pull back out and put into the business if necessary, then the business itself doesn't actually need that much. But that might be a separate issue.
Okay, thank you. Hopefully that was helpful, Alan. And moving on to Neil. Neil has asked, in a professional services area that has patents, trademarks and trade secrets that lead to licensing for manufacturing, how could that be valued?
Future revenue streams. So, what are those assets worth to you? How much revenue are they going to generate in future compared to if you didn't have them? That's one way of looking at it.
Yeah, it's certainly a difficult one where there's no obvious market for something that's intangible like that. So yeah, possibly those discounted cash flows might be the way to go.
Makes sense to me listening to that. Hopefully that was helpful, Neil, an area to explore. And we have a really, what I think is a great question from Carl, who says, what questions should we ask because we lack the knowledge and insight that you have? So I guess that's a way of saying, obviously you guys have seen and worked through so many purchases, so many due diligence processes. You've got so much experience and expertise and background. But what for those who don't? What are the questions that you would deem most important for them to be asking?
Maybe the first one is why the current owner's getting out. That, is it for health reasons? Is it because they're retiring? If they don't, those are all very good, valid reasons for getting out, but any other reasons, you've got to wonder why, and are they hiding something about the performance of the business, or problems in the industry, or future technology issues, or the highway bypass is about to be built, that kind of thing. That's a good starting point.
I agree, and I know this isn't going to sound very accounting or very technical, but I think you should trust your gut. And if your gut feel is that there's a particular question you should ask, then you should ask it. What's that saying, that the only silly question is the one that's not asked? So I think you really do need to trust your gut a little bit on the sorts of questions that you do need to ask. Obviously, the due diligence checklist, it provides all the questions you should ask. But if there's some burning question that is in the back of your mind that you really think needs to be asked, I would ask it.
Yeah. Going back to the due diligence stuff, be really careful with the team. We've had some clients with bad experiences recently where, the business was supposed to come with key personnel, and it didn't. The people changed their mind. So sometimes making sure that there's a clause in the contract that, either the price gets discounted, you get a refund effectively, if they don't, if the key employees don't stay like they're supposed to. Sometimes the better way of handling it, carrot rather than stick, is to offer those team members an incentive to stay for, say, 12 months just to get everything settled. So if you stay and if you make sure everything's settled, we'll give you a bonus. If you still need to go after that, fine, but we've at least transitioned nicely.
It
just depends on the business you're going into.
Okay, well, I think that we've answered all the questions that are up at the moment. Now, of course, this, as I mentioned before, this recording will go out in an email to everyone. If a question comes up, there's two ways that you can handle that. You can book yourself in for this complimentary session, which is on the screen at the moment, or you can just send us an email and reply to the one that comes through to you in tomorrow's email with the recording attached and the handouts. Gavin and Melissa, is there anything that you would like to leave our attendees with, apart from a huge thanks for investing the time and energy with us? But is there any last thoughts that you'd like to leave with them? I'll start with you, Gavin.
No, I think we've pretty well covered everything. I think my key takeout is obviously do your homework at the beginning, do your SWOT analysis, set your business plan, and then once you go through the entire process, don't put that business plan in the bottom drawer. Keep referring to it. It's a living document, and it's your roadmap to your ultimate exit strategy.
Yeah. And all I'd like to say is, yes, very wise. All I'd like to say is that we strongly recommend that people do focus on their business skills. Buying a business is not buying yourself a job. If you just want to do what you do because you're really good at it and you love it, fantastic, but do that for somebody else who can look after all the headaches for you. As a business owner, you're going to need those financial skills to manage the business properly. You're juggling cash flow and pricing things and all that kind of stuff. You're going to have good marketing and customer service skills. You're going to have brilliant HR skills to be able to keep your team under control and happy. And you need to set aside the time to document your systems and processes to make sure that when you decide that you've had enough, that the business is worth a lot more to be able to sell to somebody else. So we talked before about working on your business, not in it. It's making sure you do set aside that time and you've got the skills to be able to handle all the other aspects of running a business, not just the technical stuff.
Absolutely. Well, thank you very much, Melissa and Gavin, for sharing your expertise with everybody here. And as I said, thank you to everyone for coming in and spending your lunch hour with us today. This is the second in an ongoing series of webinars that DFK ANZ will be running. You're now a part of our community, so we'll let you know when the next one is due, and you can join us again if that one is of interest and relevance to you. So just a reminder to apply for your session with us with that address that's on the screen at the moment and is also in the chat box, and all the other areas that DFK can help you with if you're looking to have partners in maximising the profitability and the future of your business. So thanks very much, everybody. Enjoy the rest of your day, and we'll talk to you again soon. Take care.